Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're joined by a very special guest, Tom Sosnoff. Many of you know who he is. First, I just want to say a big thank you to Tom for joining us. Tom, can you hear us?
I can, Tony. Thanks.
Thank you so much. So today we have a lot to cover here today. We'll talk a little bit about trading, what we're looking at in the markets, but more importantly, we want to answer your questions regarding the markets right now and making sure that everyone is able to ask Tom some questions and tell you a little bit about Tastyworks and Tasty Trade. Now, just like all of our previous guests, we want to keep things really simple here today. I'm going to start off by just having a really open conversation regarding the current market environment, get a sense for what Tom is trading today, and jump right into the questions that you guys have submitted prior to this. We got a lot of questions for this webinar. I know a lot of you are interested in asking Tom some questions. So we unfortunately got more questions than we can cover here today, but I did try to pull out the ones that I think are most relevant for a lot of people to be able to get answers to the questions that you guys want to with respect to options trading. And if time allows, at the very end, we'll do a live Q&A session so that you guys can submit more questions for Tom. Now, a bit of housekeeping before we jump into it. Tastyworks is currently running a trading challenge. This is an interesting challenge to be able to take $5,000 in a paper trading account, trade stocks or ETFs with it, and whatever you earn in 2 days, you can get up to $250 in your funded account when you open an account with Tastyworks. And you can start that challenge by clicking on the link that I just shared with you in the chat window. So with that, let's go ahead and get started. Once again, I want to welcome Tom. Most of you already know who he is, but Tom, I want to give you a couple of minutes just to give everyone a little background about who you are. Tell us a little bit about your company, the difference between Tastyworks and Tasty Trade, and let people know a little bit about you before we jump into the conversation.
Sure. Well, thanks, Tony. And it's a pleasure to be here today. I don't think we've ever done a webinar before, although we do know each other and have for some years. So it's very cool to be on with you. And I get your stuff every morning and I read it. So I am a Tony Zhang fan, and so that's very nice.
Thank you so much.
I started years ago. I started on the floor of the SIBO when I was in my early 20s, and I'm in my early 60s now. So it's been 40 years in this business, and for 20 years I was a market maker, and then we built a company called Thinkorswim in 1999. Scott and myself, and actually Scott's on the chat today along with Chris. So if you have any questions, this way Tony and I can just go ahead and do the webinar, and Scott and Chris can answer any questions you have. You can fire off anything at them. Nothing is off limits. So just feel free to ask any questions. And Scott and I started. Scott and I built a prop firm together in the late 80s, and then in the late 90s we started to build Thinkorswim, and then we launched in about 2000. And then we were a public company, so we were bought out in 2009 by TD Ameritrade. And after that, we went off and started Tasty Trade. The reason we built Tasty Trade is we wanted to change the universe of financial media and content. We weren't doing what we considered to be investor education. We wanted just to do evolving media. We thought that there was a piece missing. We were building all this cool technology, but we felt we felt like that we had changed the world of online trading, especially in the option space, by building some really cool technology, but we just didn't think that the content was up to the standards of the technology. So that's why we built Tasty Trade, and we built that in 2011. So we've been going on it now for 8 years. And then in 2017, we decided to launch another brokerage firm because we liked the model of having the brokerage firm actually, the network being kind of content marketing, and then the brokerage firm being the source of revenue. And we also felt that this way we could build new technology, which we have today, the newest platform in the world and the most active platform and the fastest and the most stable platform in the world right now, that would allow customers to trade also with kind of our vision of the content in the background. So So the technology speaks to the content, and it's a really nice relationship. We also can control the fee structure in that case, and that's where we are today. So kind of my career, to just sum it up in the 20-second version, was market maker for 20 years on the SIBO, built Thinkorswim for 10 years, built Tasty Trade 8 years ago, and then Tasty Works 3 years ago, we launched it. And so it's been kind of a lifelong, I have fun now, Tony. I only do things that I want to do, and I would do webinars every afternoon if I could. If enough people would have me, I would do them, because I love talking about the markets. I love talking about trading, and I think it's fun, man. It's my life.
Yeah, I hear you. I'm the same. I probably now average 3 to 4 a week now across the different clients, and I love teaching, and this is great. And I've been a follower of you since Thinkorswim. I actually learned how to trade options on the Thinkorswim platform back in 2005, 2006, watching your webinars on Thinkorswim, and that was new at that time. No one was doing options trading webinars every single day. I remember listening to you.
Oh my God, I was a junkie, man. I was doing it. We built into the platform, the ability to do live streaming webinars right inside the platform, and I would do weekly webinars on top of it. I think we turned on, a few 100,000, between a few 100,000 and maybe 1 million people onto the world of option trading over the last 20 years. So it's been an incredible journey, and it's really awesome that guys like you that may never have even entered this field. If we hadn't built this stuff, it's so cool, and I love hearing those stories, because we never would have gotten this business either if there wasn't somebody that had in some way got their hooks into us or inspired us in some way. So I think it's super cool. And if we can turn anybody on that's listening today to a different level of engagement, man, that'll be awesome.
Yeah, absolutely. And absolutely. And that's how I learned how to trade options, and inspired us to start Options Place. So thank you so much for doing what you do and continuing what you're doing with Tasty Works and Tasty Trade. And hopefully we can show users a little bit about, what you have to offer now. So let's jump right into it. I want to talk to you a little bit about the current market. We've been talking quite some time here at Options Play about that big breakout at 302.50 on SPY in late October. We've had a pretty nice rally since then, a brief consolidation over the last couple of weeks. And I wanted to kind of get your views as to where you think the markets are. Do you see a continuation higher? Do you think things are a little overextended? Let's start with that, and then I have a few more questions for you regarding the current market. And if you want to take over your screen and show the platform, I'm happy to go ahead and do that right now, so that you can share your screen and show us what your thoughts are.
Sure. So I should say that I'm an incredible market. I've studied the market every day of my life for the last. I'm basically a junkie, and I sit in front of the screen, and I have for every day for the last 38 years or whatever it is. And I would say that I consider my record so incredible that I am about 50-50 when it comes to market direction. So after a lifetime of tape reading, scalping, and just to give you an idea, I'm still very active in the markets, Tony. I mean, like today, I made a little over 100 trades. And so I average about 50 to 70 trades a day, and today was a little more active than usual. So I want everybody to understand that, I'm speaking to them from a standpoint of I'm very active in the marketplace. I've never backed off. But I am, I know my limitations, and my limitations are, I'm directionally challenged, I guess I could say that. But if you want my feeling at these levels, anytime we get to a level of a complacency like we are right now, anytime we get to a level of new highs, the contrarian in me just takes over. It's a natural instinct. I'm a premium seller. I like when markets get extended, because I get naturally short deltas. And at the point that we are right now, I feel like we're at a level where I don't know if the market's, obviously I don't know if the market's going lower. I don't know if the market's going higher. I don't really know any of that. But what I do know is that there's incredible velocity risk to the downside here that does not exist to the upside. And what that means is, if the market was to turn south here, the risk or the pot odds of what you potentially could make on a down move is greater than I think what you could make on an up move. So for me, the offering or the best potential odds or the best risk reward is to play the downside here strictly because we are so extended and volatility has contracted so much, and it is mean reverting, that not price being mean reverting, but volatility being mean reverting, that at these levels, I believe the best risk reward play is to the downside. It doesn't mean we're going lower. It just means that's the best risk reward.
So would you be buying maybe slightly out of the money put options here? Is that how you'd play that?
No, I don't buy any option premium. Those days for me are, that's 2 decades in the past. But I am playing the downside with a lot of what we would call static delta. So I have a lot of short deltas kind of across the board. I'm leaning all my positions a little bit short. And, so like obviously today was not a good day, but I'm leaning my positions a little bit short. And in the major indices like the S&Ps, I have static delta, which means I have either short futures, short stock, or short, kind of some meaty options.
Got it. Understood. So actually, let's bring up Costco. Costco reports earnings today. We're actually long Costco. I'm curious as to what you're doing in Costco right now.
So I came in today very neutral in Costco, and with earnings this afternoon, I consider earnings to be a binary event, and so I traded Costco actually really small. I can show you my position right here. It's kind of, I've had a lot of positions on there today, and I just cleaned it up. So my Costco position is very small right now, and I went home tonight short a 5 lot of December strangles and a 15 lot of January strangles. It's pure short premium, 0 delta. Maybe like, I don't know, a tiny little bit of short delta, but it's nothing. It doesn't even count with earnings coming out. So I basically went home equidistant away. The stock closed, just over 295, and I went home short, puts $20 out of the money and calls $20 out of the money. And then right here, $17.5 out of the money and $17.5 out of the money. So this is a pure short premium play, just playing the binary event. I'm betting that tomorrow, this 32% implied volatility in December will drop down to just about 20 and match February, March, and April. And the January vol will lose about 3 points as well. So I'm just betting on a vol contraction tomorrow and the stock to stay inside of the expected move. And I believe the Costco expected move was about like $6 or $7.
Yeah, it looks like after hours are down about $2 at 295 right now. So it looks like
you can see the market on the screen right here. It's 295 to 295.50. So it's kind of a wide after hours market, but I believe the number should have come out already.
Yeah, it did.
So that's a really, for premium sellers and like for the position I have on, that's the perfect position. It's just up or down, anything up or down less than $6, and this position will be a winner. That's all we did.
Yeah. Well, that's great. Anything else that you're currently looking at in terms of trading?
Sure. I mean, my biggest positions right now are in some of the bigger name stocks. I like to stick to liquid underlines because I think liquidity is really important, obviously. And so we have a fairly large position in Apple, which we have a lot of reasonable amount of short delta in Apple. And I have a reasonable amount of, this is Apple. It actually closed up on the day after being pretty weak for most of the day. And so we have a lot of positions on in Apple, and I just think Apple's gotten to the point where it feels like, I'm not saying it's going to go down, but it feels like it's really rich up here. We're a little short Apple. We're a little short Tesla at these levels because Tesla's had an unbelievable run the last couple of weeks, really.
Yeah.
We're a little short JP Morgan. Those are 3 of the stocks that have had monster runs, and JP Morgan was up like $4 today. We're short a lot of premium in some of the commodities too. So are you trading futures at all or no? Yes, sir.
We are not as a group. I do myself,
okay.
But as a group we do not. But actually, this brings up a really good question, and quite a few people did ask this question throughout from the previous that submitted the questions, and there's a few right now. It's just, can you talk a little bit about the term short and long delta? What does that mean at the end of the day?
Sure. So delta, and if I go out, I like to sometimes go off on some crazy little tangents. So always, drag me back if there's stuff we're talking about that somebody doesn't understand. But when you look at like Apple, just as an example, and let me just open up some January options here so you can kind of see. I'll make it real simple. Like the stock is trading for 271.40. That's where the closing price was today. And on our platform, we show that where the line is across the platform. But if you go to, let's say, an out of the money option, like the 280 calls, the market on the 280 calls in the close was 335, 350. But how does an individual investor put into context what that market means? Forget about the actual market of 335, 350. But what is, how short is that? If you were, let's say you were to sell these 280 calls, how do you know how short that is? Well, what you do is this column shows you the delta, and the delta on these is 32. So if you were to trade one of the 280 calls and you were to sell it, you'd be selling 32 shares of stock, the theoretical equivalent of 32 shares. Even though the 280 calls convert to 100 shares of stock at expiration, if they should be in the money, the theoretical value at this current time is 32 shares. Now, if you were to buy these options, you'd be buying 32 shares of stock. If you're selling them, you're selling 32 shares of stock. That's the theoretical equivalent. If you said, okay, well, it's too much money to sell those naked because, whatever, I don't want to put up that much capital. Let's just say you decided you were going to buy the 285 calls. So what happens in this case is, if you want to know how much theoretical apple you're long or short, since you're selling the 280s and buying the 285s, all you do is subtract the 285. You take the 285 delta, the 280 delta, and you subtract the 285 delta from it, and the difference between these two is 9. So this is the equivalent of being short 9 shares of stock. So if you sell the 280, 285 call spread, you're short 9 shares of stock. If you just sell the 280 calls, you're short 32 shares of stock. If you want to be short more stock than that with a higher probability of success than selling the stock outright, maybe you sell the 275 calls, and that's the equivalent of 43 shares of stock. So what delta is the theoretical equivalent to stock. And you can look at it at spreads, you can look at it as individual options, you can look at it as put-call delta. So for example, if you wanted to sell the 280 calls and you wanted to sell, and you want it to be like, let's say, neutral, you would look for a put that's right around the 32 put. So you'd sell like the 265 or the 260 puts, either one of those. And that would be considered like a delta neutral strangle. If you want to make the strangle a little bit long, a little bit short, you can move the puts down to the 260 level or to the 255 level. It requires no additional capital. So the beautiful thing about options is that they're strategic and they're not black and white. So with whatever capital you're using to sell the 280 calls, you can sell a different put against it and improve your probability of profit. I hope that answers the delta question without going off too much.
Yeah, and I think at the end of the day, when we refer to long and short delta, whenever we're talking about long delta, that's a position that will appreciate in value when the stock goes higher, and a short delta trade will actually appreciate in value when the stock goes lower. So positive and negative delta tells us which direction we want the stock to go in. So hopefully that answered that question. So Tom, let's actually jump into some of the questions. We don't have a lot of time, and we do have a lot of questions on deck. So first, one of the questions that Bruce asked is, can you just provide a brief comparison of Tastyworks with Thinkorswim and kind of how to open an account with Tastyworks? And
sure.
While you answer that question about Tastyworks versus Thinkorswim, I will post a link in the chat window with how to open an account with Tastyworks, Bruce.
Well, I'm one of the few people that actually know how the sausage is made on both platforms. Thinkorswim was our baby. We built it from idea stage all the way through to every line of code that was in that platform. And then we did the same thing with Tastyworks. So, and it's basically the same designers and same developers. So the simplest way to explain it is Thinkorswim was a revolutionary platform when we built it in 1999. It changed the way individual investors and self-directed investors interacted and integrated themselves and engaged themselves with front-end, customer technology. It is really an amazing platform. But that was 20 years ago. And now, it's an older legacy platform at this point. It's still a great platform, but it's just an older platform. We built Tastyworks in 2017. And the difference on Tastyworks is, first, that it's one single page. It's all in front of you. There's no other screens to pop up. Second, it's not bloated. Third, it's built on high-frequency middleware. It's the only platform in the world, customer platform, built on high-frequency middleware. So it's lightning fast compared to all the other legacy platforms out there. So it could be 20 to 40 times faster than than Thinkorswim or some other platform like it, legacy platform. It is much more stable, and the quotes are not throttled, so the quotes are much faster. So the platform is designed so it's all in front of you at all times. None of these pages that you're looking at, none of these screens ever change. I mean, you can, for example, put up, a charts if you want, and you can go back to a trade page, and you can actually see a specific trade in a curve mode, with you can see it in an analysis mode. You can see it in an active trading mode. You can look at positions. Oops, I'm sorry, I don't show this. You can look at positions in lots of different ways. Let me go back to the table mode. And like you can look at, for example, an Iron Condor real simple by just clicking on a button, and you can adjust all these strikes by dragging and dropping everything. So it's just the ease of use and also the way we display things. So we'll give you multiple displays. We'll give you a graphical display, which we call curve mode. We'll give you a traditional display, which we call a table mode. We let you, you don't have to click, type, or do anything on this platform. You can route any order in any combination, so it's no recognized spreads. You can route any order with any combination of legs, with any quantity on any leg, and all price discovery is done for you within the platform. So you don't have to worry about, am I getting the best price, or am I doing all this? Everything's done with the high-speed technology that we built into this middleware. So it's an amazingly simple, fast platform, and we're trying to revolutionize the space again, because again, we've integrated content in the platform on a single page, and everything is right in front of you, and everything is free. We also show things like POP, which is probability of profit. We show P50, which is your probability of reaching 50% of max profit. We give you some of your Greeks, your delta and theta. We give you max profit, max loss, and your buying power effect all right in front of you. So we make everything on this platform super simple and right in front of you. How does it differ from TOS? Less features, faster and more stable, and easier to use.
Well, I think that's a great summary of, I've used both platforms, and I still trade on Thinkorswim, to this day. But this is something that I'm starting to learn more about Tastyworks and moving my trading over there. A lot of it due to the fees. And I don't know if you want to talk a little bit about kind of.
Well, we've done some really special stuff for the fees. I mean, for people that don't know us, we were the first firm to go to zero for all closing trades, and we still have that today. We also cap all option trades at $10. So you can never pay more than $10. Like if you do 100 lot or 1,000 lot or 500 lot or 20 lot, the most you can pay any leg is $10. But it's not just the fees that are important on Tastyworks. What's really interesting here is when you get used to this, Tony, the ability to roll trades. Let me show you something. Let me just clean this up for a second. Let me clear this page. What we've done that's super simple is, like, I'll go over here to my Apple position, let's just say, and let's say for some reason I'm short a bunch of 260 puts. If I wanted to roll these puts from January to February, I just right click on the puts, hit quick roll, and there's my January to February roll trade done. And it's the same thing for stock options and futures and futures options. It makes no difference. So for example, if I wasn't trading Apple and somebody, today bonds were in play huge. They were down 204. Let's just say you want to trade bonds. It's the same look and feel in the bond market, and you trade everything the same way. You roll everything the same, you trade it the same, and you can even trade bond options the same way. It's super simple. So we've made the platform agnostic to product, agnostic to strategy, and we support any strategy, agnostic to size, and anybody that signs up when you open an account with us and you sign up for the works, there's no different levels. Your permission for everything, stock options, futures, and futures options. And with IRA accounts, we allow you to trade futures, futures options, stock options, and any strategy, including naked options. So we're very aggressive in what we let people do strategically, and it's just a really special platform. When you use it, it's amazing the feedback we get. It's the fastest growing platform right now in the world, and it's because it's so easy to use.
Well, thank you so much. Let's get to some of these options related questions, right?
Sure, fire away.
And Tom, I think you've done a really good job of of helping beginners go through the learning process of how to trade options. So Casey asked, what is the gradual progression in terms of strategy for options trading strategies for new traders? Kind of where is the progression you see from someone who's an absolute beginner as they progress into trading?
So it's a great question, Casey. And I think my answer is going to be a little different than most people would give you. The most important thing you can do when you're starting out trading options, and this goes to everybody that's on the call today, it's not about the progression of strategy. To me, it's not. I believe that, of course, people will say to you that, if you're going to start out, you should start out with covered calls, you should start out with naked short puts, you should do something that's easy to understand, or vertical spreads, or Iron Condors, that kind of stuff. I don't think that's the best way to learn. I think the best way to learn is to teach yourself the mechanics, and teach yourself how to achieve whatever probabilistic outcome you want. Now, let me explain that. What I think the most important thing to do when you're learning is A, stay in the most liquid underlyings you can, and B, stay super small. The key to long-term success when you're trading anything, stock options, futures, anything else, and part of the learning process, which is developing the mechanics, which is developing the decision-making skills, which is developing the brain processing speed to make all those decisions, the two keys are stay in something that's liquid, so you can't get yourself in trouble, and stay small. And if you do that, there's no reason you have to define your risk. There's no reason that you have to do something that's what we call super simple. It's not like being forced to play the slot machines when you really want to play something else at a casino. My feeling is that regardless of the strategy you select, if you stay small, and I'm talking about as small as you can get, if you stay small, because you're not penalized anymore by high transaction fees or anything like that, just stay small, stay liquid, and then try strategies that have the highest chance of success. So let me give you just a quick example. Let me go back to Apple can I do this for one? Tony, you have enough time for this?
Yeah, absolutely.
Okay, so let's say I went to Apple, and just as a really simple example, I put up this is a classic $5 wide Iron Condor, $5 around, $5 away from the mid price. This is a classic Iron Condor. And let's just say in this case, the statistical, let me widen this out. I want to make it so it actually has a lower probability of profit. Hold on. Let me do this for a second. I'm going to move it down here just so somebody can see this, so it makes it more natural, like a realistic trade. Okay, so what I've done here is I've set up an Iron Condor. I've just done it just picking any strike. It didn't matter to me. The strikes are $5 wide. I'm collecting $1.82. So that's just under, it's one of those trades where it's kind of like a 60-40 trade based on the credit received. We're receiving about little under 40% of the width of the strikes. So you're going to have just right around a 60% probability of profit on this trade. If, for example, and if you did this one time, you'd be risking $3.18 to make $1.82 max. But if you took off the long legs here, now I know it's going to cost more money, but if you took off the long legs here and you just sold this strangle, okay, the difference is it goes from, something, and you can see the probability of profit over here, but it goes from what it'll say here, probability of profit about 55 to probability of profit, around 65. And that's, one is theoretically accurate and the other one is understated. Like this being a 65% probability of profit actually comes in closer to 75 because it's defined profitability, undefined risk. The other one on the Iron Condor is exactly whatever it states on the software, like 58% or whatever it said. So what happens here is you're about 20 or 30% better chance of making money. Now, it's riskier trade because you have unlimited risk. But if you stay small, and let's say you did one contract or whatever it is, if you stay super small, you actually have a better chance of success. And the best way to learn something is to have the best possible chance of success. So I differ from kind of traditional investor education in the sense that I want to see people have the highest probability of profit, not necessarily take the least amount of risk.
Well, I really like that answer because that really allows people to explore. And I love the fact that the platform allows you to trade all of these strategies in your account. And, we always teach trading small. That was the webinar we did last Thursday was, what amounts to actually trade in your account to trade small. This is something that a lot of people don't necessarily follow of trading small. So this is really something that I think is great coming from you. So the next question, Jurgen is asking, is there an edge in using Greeks to help you determine your trade setups? And, how do you identify if options are cheap or expensive?
Oh, that is a great question. Who asked that? Jordan, did you say?
Jurgen from
Jurgen.
Germany. He said he's very happy to ask Tom Sosnoff. He's seen you at the money shows, and he thinks that you're really excellent, and he wants to become the best U.S. options trader in Germany.
I love it, Jurgen. Nice job out of you. So I'm going to give you an answer that is very specific to our technology, but it's also very specific to the mechanics that we use. So will the Greeks help you to make money? Well, they will provide some guidelines and some ranges, and they'll provide you context, but ultimately, no, they're a math equation, and they're not necessarily going to help you, quote, make money. They are going to keep you in line. Like, in other words, you'll be able to manage, for example, your deltas. You'll be able to manage your theta numbers. You'll be able to manage kind of, your delta and theta provide you kind of give you the best indication of risk. But how do you determine whether options are expensive or cheap? And that's a great question. And I think we've got to a point that very few other people have got to. So if you look on this platform, and I'm looking at Apple, if most people, if you request a quote in Apple, the first thing you're going to get is, the bid and the ask, right? What we do is the first thing we give you is the IV rank. What that is implied volatility for the last 1 year measured against itself in Apple. So if Apple implied volatility was high, which means option prices are high, then the IV rank would be high. And on a scale of 1 to 100, this is only 13.3. So that would suggest that implied volatility in Apple right here is super low and option prices are cheap. If I went to TLT, just as an example, and said these are bonds, these are the ETF for the long bond, and the IV rank is 40, that suggests that bond volatility is high. If I went to Costco, because Costco had earnings this afternoon, and I would see that the IV rank was 44, almost 43.9. So I would know on a scale of 1 to 100, that is a reasonable number where the options are expensive, or they're not cheap, let's put it that way. But for example, if I went to Tesla, just thinking, hey, I want to do something in Tesla, right now the IV rank is 5.3. That's the lowest Tesla's been in almost 2 years, in that under 10 range. So the options in Tesla right now are really cheap. So one of the things that Tastyworks and TastyTrade are really focused on is mechanics built around IV rank, so we can give you context. I feel like it's the most important indicator that we come up with and that we use, and it gives you real context over whether something is expensive or cheap, and then you can design strategies around that.
So I just want to ask one question. With the IV rank, you mentioned that you're measuring IV against the last 1 year. What IV are you actually measuring against the last year? Are you looking at 30-day, 60-day? How far out are you looking for?
We're looking at the next cycle we're looking at the next cycle that's outside of 21 days. So in this case, we're looking at Jan options.
Got it.
So right now, you see this number here? We're looking at this 41% number in this Jan number in Tesla. And so as you can see, Tesla's earnings after Jan expiration, that's why the back numbers are a little higher, but we're looking at this 41% number right here.
Got it. And considering how important IV rank is, I think it's also important to talk a little bit about the way that IV rank is calculated, and the fact that most of them are concentrated on the lower end. That it's actually very, very rare to see a IV rank significantly higher than 50. Right? Most of the time, you'll see an IV rank under 50. Is that correct?
You are absolutely correct, Tony. The way the statistics plays out. And again, remember, IV is a mean reverting math equation, but you're right. 75% of the time, IV rank will be under 50. So it's only over 50 about 25% of the time, and it's under 50 75% of the time. And actually, of the 75% of the time that's under 50, it's under 20 about 25% of the time. So IV is not only is it mean reverting, it's also clustering at lows. IV has these brief spurts. It's like a down move in the market. It has these brief, brief volatility explosions, and then all of a sudden, it spends the rest of its life contracting. And that's the nature of volatility. Opportunity is fleeting with respect to volatility. So you have to be careful that you have powder dry and you're able to play it, when it's available.
Great. So let's move on to the next question. Casey is asking a really good question, actually, and I think a lot of users have this question, and I think it touches on something you said earlier about trading liquid names. But the question Casey had is, what's the strategy to deal with stubborn market makers who want the full price, meaning they want you to pay the bid-ask spread on fairly liquid options that have very wide spreads and but seemingly have high open interest and volume, and that even when you add 5 or 10 cents from the midpoint, the order kind of just sits there for hours. Do you have any thoughts on kind of how you work orders, especially in stuff that are
Sure.
fairly liquid but things are fairly wide?
Sure. So Casey, we live in a very different world today as from a market making side than from the days that, trust me, you didn't want to ever trade any of the markets that I used to make. That's how we built all our firms. Today's market making is incredibly competitive. In fact, the average edge that we give up to theoretical with respect to the market making firms is about a half a penny, which means the average spread is probably between around theoretical. It generally averages between a penny and a penny and a half max. So if you're trading something where you're being forced to move towards the bid or the ask, then whatever it is you're trading is not that liquid, because of the top 75 stocks. Usually, and it can widen out a little bit at different times, but usually those markets with and I can only speak for us, but usually those markets with us, because we maintain a part of what Scott and his team do all day long is monitor fill quality. And we will not send any orders to any liquidity provider that's much away from 1.5 cents around theoretical on both sides of, let's say, the top 75 or 100 active underlyings. Once you get over the top 150 most active, then you can get a little bit wider. But if you're finding a stock, like there's a couple stocks out there, I'll give you an example. Like for me, a stock that I feel like I never get a good fill on is eBay. But the markets are only like 2 cents wide in there during the day. But I feel like every time I trade it, I have to hit the bid or take the offer. But there are a few stocks like that that are a little bit stubborn. But for the most part, when we're talking about all equity options, all equity and index options, for the most part, they trade in between the markets, usually around 1, 2, or 3 cents around mid price. Now, in the futures world, just in case you decide to want to trade futures options, they mostly all trade 1 tick around the mid price, which is the same theoretical give up as about 2 cents in the equity marketplace. So what we're seeing today is an incredibly competitive market by the high frequency market makers. There are no pit market makers left. Everything is done. Every single order you route through us is done through a high frequency prop firm or a high frequency hedge fund. And the technology today, they're filling your orders in 7 or 8 milliseconds. So there is nobody sitting there looking at it. It's all done based on theoretical, and all price discovery is done on the platform for you. So if you're not getting filled and you have to hit bids or take offers, you have to seriously consider the firm or the underlying. If you're using us and that's happening, then the underlyings you're trading are just not that liquid. But if you're using some other firm, you have to seriously consider, how they're routing their orders.
I have a follow-up question to that, and
Sure.
that really leads up to the next question is, do you typically use limit orders, market orders? How do you like to work your orders?
100% marketable limits. So first of all, I don't think I've used a market order in 20 years. Everything I do, Tony, is what we call marketable limit. So what I do is I will put my order in, everything's a limit order, but I'll move it a little bit off. I'll move it like a penny off of mid price to start, and then I will move it, one more time. If you're doing a straight order, you can put it in wherever you want. Obviously, if it's not a spread, you can put it in mid price. You can hope for the underlying to move. You can put it in a penny or two away from mid price. You're going to get better fills in 2019. You're going to get better fills on spreads than you will on individual orders, because spreads are easier for the counterparty to hedge. So the spread markets are way tighter than the individual stock markets. And that may have been what Casey was just referring to. But the spread markets are tighter. And for spreads or individual orders, I would use what we call a marketable limit order, which means it's a limit order, but you're giving yourself, maybe a penny or two around mid price, that kind of thing.
Great. And I think this really leads up to our next question, which I actually think is a great question is, is there a time of day that you prefer to enter your options orders, or is there any time of day that you avoid entering your option orders?
So this answer has changed for me. 20 years ago, I would have said absolutely. There's the most activity, and it's the best time of the day to enter orders would be the first hour, obviously, or potentially the last hour when there's the most traders around. But in 2019, it makes absolutely no difference. Your every single trade is being made against. You almost never trade against another trader or a or an individual market maker. Almost every trade is made against a computer. It's against an algorithm. And so it doesn't make a difference if you trade at noon, 11, 10, 9, 8:32, or in Central Time, or 2:59 Central Time. It makes absolutely no difference. So whenever you put in orders today, the fill quality is almost going to be exactly the same. It used to matter. It doesn't matter anymore.
That's really good information. So Tom, next question from Ed is, do you look at option money flow? Do you think that impacts the underlying stock, bullishness, bearishness, et cetera?
Yeah.
Do you look at unusual volume? Do you look at what
No.
people are trading?
So Ed, I feel really strongly about this. Unusual volume is kind of more of a sales technique. I don't believe, I've been doing this my entire life. I don't believe unusual volume is anything more than just something that's completely random. You can look at unusual volume and it may work one out of 2 times, 1 out of 3 times, 1 out of 10 times. I have no idea. But unusual volume is nothing more. If you're trading against it, you'll end up with completely random results over time. I don't think there's anything to that. We do not look at money flow either, because for us, okay, that is not, you're trying to, when you look at money flow or you try to look at volume or things like that, you're watching the same movie that everybody else is watching. And then you're just dealing with, it's nothing, to me, that game is nothing more than a game that ends in random results. I would much rather individual investors and individual option traders focus on statistically high probability strategies. Like Tony, a lot of stuff that, because I see your trade recommendations, okay? And it happens to be in Chicago. I'm up at 5 in the morning when you send yours out. And so I see it. And the stuff that you do, it's strategically high probability. You're doing a lot of stuff where if you're directional, you're doing stuff that has either a 50-50 or better shot. And if you're selling stuff, you're doing stuff that has 60 or 70% probability of profit. You're doing that for a reason, because if you do it enough times you're going to hit. It's just law of large numbers. Everything is so priced so efficiently that theoretically you're going to hit whatever your expected number is. Doesn't mean you're going to make whatever your expected amount of money is. It just means you're going to hit your theoretical number over time.
Absolutely. I think that's a very good way of putting it. As far as that goes, we do have limited time, so I'm trying to get to as many questions as possible here. Mike is asking, in an up market, I found rolling cash secured puts to be very profitable. Is there some risk that I am missing?
No, in fact, Mike, in an up market, rolling cash secured puts is puts are schmutz. So we're talking about, rolling cash secured puts in an up market is obviously one of the more beautiful strategies. In fact, in 2019, you almost didn't take any heat all year. It's one of those rare years. In 2018, you would have had the living bejesus scared out of you in January and December. But in 2019, we didn't have a single scary down move the entire year. Obviously the risk is you get to a certain level of complacency and, you're tightening the rubber band type of thing. And eventually, they're going to scare the children. But if you're bullish and you're rolling cash secured out of the money puts, statistically speaking, it's the best strategy known to man.
I think it's one of the most underutilized strategies out there. A lot of people shy away from it because they see the max risk on that strategy, but you really have to think about the fact that, if you had purchased the stock outright with the limit order or at the market order, you're going to be risking more money. So Tom, Mura is asking, And this question is really more along the lines of security selection, but how do you go about selecting your securities? Do you use a top-down analysis? Do you use multiple time frames on your charts? How do you go about deciding what stocks to trade?
Sure. So thanks, Mira, for the question, because I'm a little different. I'm a little bit of a freakazoid when it comes to stock selection. So I don't do things the way everybody else does. I'm not a technician, and I never have been, and I'm not fundamental. So I'm not fundamental or technical. So there is no fundamentals to the way I trade. There's no technicals. I'm purely a what I would call it is a strategic or kind of math/quant based statistical junkie. So what we do is I will focus on things like this platform has built into it incredible scanning capability. You can scan for, for example, IV rank here. So one of the things I'll do is I'll look at stocks with high IV rank because I'm a premium seller. Or if I don't want stocks with high IV rank and I'm in the mood to kind of like to do something that is more directional, I'll scan for stocks with very low IV rank, and I can see there. And then if I'm curious about liquidity, I'll scan for stocks that have the most liquidity, so I make sure that I'm lining up my IV rank with liquidity, and there's lots of other things like that. So for me, for picking stocks, I focus on stocks that are very liquid, and because I prefer to sell premium, I focus on stocks that have high IV rank. Other than that, I don't care. I'm agnostic to product, and I am relatively agnostic to strategy, but I do like to create credits when we're trading. So I don't think of things now. Over time, you're going to get very directional, Mira. So it's not a question of, I'm not sitting there saying I'm non-directional, because that's not the way I trade. I'm not a non-directional trader. I just talk about it in the sense of non-direction because I'm very opinionated, and I don't think my opinions, my market opinions should matter at this point to you.
Well, I think that actually brings up into our next question, which is very closely related to selling, and that's predominantly what you do. And Ira is asking, in my dividend yield portfolio, are long-term options as cover calls better than intermediate-term options? And I think this question, expands beyond just cover calls, right? I think
Sure.
for any options selling strategy, I guess the question is really kind of where do you typically like to sell on the curve? Short-term, medium-term, long-term.
So we are Tony, this is a question that we have spent literally hundreds of hours research. So I should have explained at the start. So Tasty Trade is a think tank. We hire data scientists, we hire researchers, and we hire statisticians. And basically what we do is we just research options, and it's all quantitative. And one of the more interesting things is duration, because duration is what messes up everybody or confuses everybody. And if you're doing a covered call, or you're selling a strangle, or you're selling a naked put, or whatever it is you're doing, the optimal time frame for anything is 45 days. In the world of the decay curve of options, and since you specialize in options, the decay curve, as you know, it's pretty slow from like 120 days down to 50 or 45 days, and it starts to speed up when you get inside of 21 days. The optimal period on the curve for doing anything is 45 days. It's the highest rate of decay with the best dollar for dollar risk. So, or the lowest standard deviation of risk with the best dollar return. So 45 days is your window. So if you're doing covered calls and you're looking for the perfect time frame on covered calls, it's 45 days. Now, the only time that you would go longer, you never go shorter if you don't have to. I mean, you can listen, when I say 45 days, if the closest option out there and it's monthly is 30, you go 30. If it's 35, you go 35. If it's 50, you go 50, whatever, it's close enough. But the only time you go longer than 45 days is if we're in a period of extreme high volatility and you think you can squeeze another month out at some ridiculously high level that you'll never see again. But for the most part, 98% of the time, you want to be in that 45-day window.
Could you comment a little bit about holding that all the way through expiration, or do you exit before expiration?
We never hold to expiration. So that's the second part of the key here. So our mechanics are you do something at 45 days, and at 21 days, you roll, close, or you adjust the position, you roll the position, you close the position, you do whatever you have to do. But the key window which gives you the highest probability of success and the lowest standard deviation of risk, is from 45 days to 21 days. That 24-day window, you take the least amount of risk for the best potential return on capital. Once you get inside of 21 days, and specifically inside of 10 days, you have the worst risk reward in the entire world of options. So you want to do something at 45 days and make your adjustment and do whatever you can do to that at 21 days.
And do you find that is because in that 21 to 10-day window, that's really when the gamma risk starts to kick in?
You're spot on. That's exactly it.
Got it. Okay.
And here's the craziest thing, Tony. That little tidbit right there is the most important thing that I've learned in the last 8 years of doing Tasty Trade. And it is the most research thing that we've done. We've probably, at this point, done a few thousand hours of research on that. And it is incredible how it's changed my trading. And I thought I was like, old dog, can't teach me anything type thing. And it's incredible how it's changed my trading. I trade completely different in 2019 than I traded in 2016. Forget about 1986 type thing.
Yeah, I mean, we have quants here in-house doing some of the same stuff, and that gamma risk really is something that we've started looking at this year and really understanding a little bit of, and it's really a very costly thing to hold options in that, especially short options going into that.
Yeah, listen, I was the one that actually created the weekly options for the SIBO, and so we proposed the whole weekly option. We introduced weekly options to the new product committee at the SIBO and had them introduce it in the SPX. And it's kind of, and that's when we owned Thinkorswim. And that was my proposal that we put together that created it, which is like 25% of all the option markets now. But at the time, the reason we did it is because we actually believed that the highest rate of decay and the best risk reward was that last 7 days. But we were totally wrong. We created it for all the wrong reasons. We just didn't know any better. And that was like 2005 or 2004. So it wasn't like this, 30, 40 years ago. It was just like 14, 15 years ago.
Yeah. We've been doing a lot of back testing with those weekly options, which listed in 2010, I believe, roughly around that time.
Some of them, yeah. Some of the equity ones, yeah.
Yeah. Great. Thank you so much for that. So let's move on to the next one. This next one I actually thought was interesting. Robert asks, is it a good income strategy to sell weekly cover or sell cover calls, but at the same time also sell a put along with that, somewhat otherwise maybe known as a covered combination? And if so, what type of stocks would you use for this type of strategy?
So first of all, that strategy, if you're talking about doing a covered call along with a short put, no, it's not a good strategy. And obviously in a bull market, it's a great strategy because you're just playing, it's 2 times to the upside. But a covered call and a naked put, if that's what he's saying, do the covered call and sell the put. All you're doing, the covered call is a synthetic naked put. So when you do that, you're just doing like 2 naked puts instead of 1. So, if you're right, great, but it's not a hedge, and I would not consider that to be a great strategy. But if you are going to apply that strategy, you would want to apply it when implied volatility is super high and the market is super low. Like this would be the worst time to apply that strategy because we're at record highs. So you have nothing but double the risk. I mean, if we were like, if this was back in 2008 or 2009, you said, hey, I want to get double long here, it makes sense because volatility was 100% and stocks were on multi-decade lows. But that's not the case today.
Right. Okay, great. There were so the next question, it's 2 people asked similar questions, and I think we actually touched up on one of them. But when you trade an Iron Condor, what are the indicators that you're looking at? Or do you look at volatility? How far away from the either end of the range are you looking at when you're selling an Iron Condor? Close to the support or close to resistance, and what time? How far out do you sell those Iron Condors?
So the Iron Condor goes the same 45-day apply. The key to Iron Condor sales is high implied volatility rank because it's a short premium play. So you have to have high implied volatility rank. Now, if you want the optimal delta for an Iron Condor, it's somewhere between the 20 and 25 delta strike. So when you're doing Iron Condor, let's say you're doing Costco, just as an example today, and you wanted to sell an Iron Condor in here, you'd want to go somewhere between the 20 and 25 delta strike. So on the put side, it'd be right here, the 280s. and let's just say you buy the 275s. And on the call side, it would be the same thing. It'd be somewhere right here, right around the 310s. You could do the 310s or the 315s, but let's just say I did the 310s and bought the 315s. And this would be a classic, January Iron Condor collecting about 40% of the width of the strikes, meaning you have just about a 60%, probability of profit. And this is what we call just a kind of a classic, Iron Condor. And again, the reason that we pick this certain number of days, 36 is closest to 45, and you want the deltas where your short strikes are 22 on this side, and this side would be 24. So they're pretty close. And that's the default way to do it. Then you can change it from, you can mix and match it from there depending on you're a little more bullish, a little more bearish. You just adjust the strikes to wherever you want.
Right. So quick summary, it's 45 days out. The short leg should be around 20 to 25 deltas, right?
Yep.
Great.
That's optimal. You can do whatever you want, but that's optimal. And you'd like to collect a little less than half the width of the strikes. And the reason for that is if you collect more than half the width of the strikes, your probability of profit drops below 50%. But if you collect less than half the width of the strikes, your probability of profit is, greater than 50%. And so obviously here, this is less than half the width of the strikes. So our probability of profit is greater than 50.
And just to be clear, when we say the width of the strikes, we're referring to the width of the two between the 275, 280 and the 310, 315, not the 280, 310 width.
That's exactly right.
Right. Great. Okay. Perfect. So for those of you that like to trade Iron Condors, I hope you got something from there. Patrick is asking, I think, a really good question. And, it sounds like you trade a lot, right? But what do you think is the adequate number of options that you should have in your portfolio? And he actually talks about the law of large numbers, something that you discussed earlier, and he said, since the law of large numbers or number of occurrences increases your probability of success, does this hinder my first question of, what do you think is what do you think is the adequate number of options that you should have in one portfolio?
So I love that man, and he asked that question because he's actually spot on. But it's not number of options; it's number of trades. So it's number of underlyings. So the number of options is irrelevant. That's all relative to account size and to risk preference, all that kind of stuff. But the number of different occurrences that you have and the number of different underlyings is what's important. Now, it does depend on account size, but I would say that, just from what I watch on our customers, and, we have 100,000 plus customers, so we have a pretty good, view of the world. I would say that at least having on somewhere between 5 and 25 positions is kind of like a minimum to achieve law of large numbers. The reason I'm making such a wide market there is because it depends on account size. If you have an account size of less than, let's say, $5,000, you're going to end up with the ability to put on between 6 and 8 trades, maybe 10 trades max, if you're closer to 5,000. If you have an account that's between $25,000 and $100,000, you could easily have on 25 different underlyings. And before you think that that's a lot of different underlyings to manage, it's not really. As long as you stay small and mix up your strategies. Remember, true diversification is not just different underlyings, but it's also different strategies. It's also different durations, and it's also different volatilities. If you do that, you achieve kind of what we call this non-correlated highest probability of profit and the best way to play the law of large numbers. So it's not number of contracts, it's number of occurrences.
Absolutely. And thank you for your insights on that. So Noel is asking, and I don't know if you have any data on this, but do you think the markets will be more volatile during an election year?
I absolutely do. I think that this year was strange in that we've had no major moves. But if you look at kind of what the volatility curve is kind of predicting going into 2020, if we had some big moves in 2019, I could see us going into 2020 thinking that there might be some contraction of volatility. But right now, we're sitting on pretty much multi-year lows in volatility, and we haven't had essentially a big scary move all year. So I think that you're going to see heightened volatility in 2020 because, again, volatility is mean reverting, and I think for that reason, I just believe it's important that people recognize that there is volatility risk. Now, I shouldn't even say volatility risk. there is volatility opportunity in 2020. For everybody that's listening today, there's a couple hundred people on here, and for everybody that's listening to this chat, this is about opportunity. This has nothing to do with risk.
I completely agree, and I actually think that I actually looked at a bit of data after someone submitted this question, just out of pure curiosity, looking at what the average returns were for years prior and years after an election. It seems like most of the big moves happened the year prior to the actual election. So 2020, going into the election is actually the year where we're likely going to see some pretty big moves.
Well, if you think about 2016 and 2008 and then 2000, I mean, those were the big years.
Yeah.
2000 was crazy. After March, it just got insane. I mean, we topped out in March of 2000, and I almost remember it like yesterday because it was, right after the internet bubble, and that was an election year. In 2008, we waited all the way till about August, and then we just imploded. And then in 2016, it was the summer. So I think that, and then again on election, I think you're going to be in for a great year. I think that people that are strategic, that are active and strategic, and people that are like listening to this chat, this is your time to shine. 2020, there's tons of liquidity. The markets have never been better. The content has never been better. The technology's never been better, and the fees have never been lower. And so you're in a position where you can compete on a level playing field with the pros, technology-wise, content-wise, and fee structure-wise. We pay less now as customers than the professionals pay on the trading floor. It's crazy. So I think this is an opportunity for everybody, strategically and statistically. And I think if we get a pop and vol, it'll be great.
Absolutely. I think now is one of the best times to be trading as a retail investor, just in terms of fees, in terms of technology, in terms of having access to what you need and the opportunities we see in the markets right now.
Yep.
So with that, Tom, I do want to really thank you for your time. If you have time, we have 3 kind of fire questions regarding Tastyworks, if you'd like to
yeah, sure.
them. And then what I'll do is, in the meantime, if you are interested in opening up a Tasty Trade account, I just posted a link in the chat window for those of you that would like to take advantage of this platform that Tom just showed us here today. But quick fire question. Number 1, when will Tastyworks be available in Canada? Number 2, is there a paper trading account in the works at Tastyworks?
We just went live in Australia. So if you have any Aussies listening, Tastyworks Australia just went live. Tastyworks Canada is in the process. We've been working on it now for over a year and a half, and hopefully we're hoping in second quarter 2020 we'll be live in Canada, but we can't. It just depends. We've had trouble finding a clearing firm. We've had trouble, going through the regulatory process. It's very complex. Let's put it that way. But the real holdup is just there's not a lot of clearing firms in Canada. Canada is pretty much controlled by 5 or 6 banks, and it's hard to find people that will clear our style of trading. But we will get to Canada, that I promise you. We have a Canadian CEO. We have spent a ton of money on legal and compliance there already. And I did build Thinkorswim Canada years ago, so we're very familiar with the process. So we're hoping to be there in Q2 of 2020. Hopefully that answers that.
Well, actually, I have a question. We have a pretty large presence in Canada, and that's why we've gotten so many questions regarding.
Yeah, I know. We have 10,000 viewers in Canada, and we can't get there. It's driving me out of my mind.
Yeah, I was curious as to one of the biggest challenges in Canada or Canadian residents have with trading options is really the fees that the current brokers up there are charging in terms of commissions. Do you see Tastyworks being far more competitive on fees in Canada, meaning similar fees as you do here in the US, or is that something that you can discuss?
Absolutely, Tony. Sure. No, we just launched in Australia about 6 months ago, and we have the same fee structure in Australia that we have in the US, the exact same. So you trade the same products, and we have the same fee structure. We have the lowest fee structure in all of Australia. We hope to have the exact same fee structure as we have in the US in Canada. I mean, I can't promise that today just because we don't know our clearing rates, but we are, it will really bother us if we're not the exact same, because we don't want to have different fees for different people in different places. So our goal is to have the exact same fee structure as we have in the US.
Well, there you go for all of you that are Canadian listeners and have complained to me over the last year about how high your fees are. Hopefully this is an answer to you guys very soon. Is there going to be paper trading in Tastyworks?
Eventually, yes. It's not at the top of our dev queue because we're building some really cool stuff, and paper trading is kind of like a little bit further down our line. We have the Trader Challenge right now, so you can the Tastyworks Challenge where you can log on and you can trade for 2 days and just trade stocks and keep all the money you make up to $250, which is kind of cool. And that's a virtual platform. So we have built a virtual platform, but we don't want to. We have a couple of things that we want to push out first, like an API, like a bunch of new functionality. So we're working on other things first, and then we'll get to paper trading. Hopefully, you'll have paper trading in 2020, but it's targeted for the second half of 2020 right now.
Okay, and for those of you that want to take advantage of that trading challenge that I showed you earlier, I just posted a link in the chat window. And last question for you, Tom. I think this is a good question. It's a fair question. Is from someone here saying that being that Tastyworks is only a few years old, but a wonderful platform, I wonder whether to transfer all my accounts to you, which are with one of the major brokers. While I know the financial well-being of my broker, how can you assure me that the assets are safe at a smaller Tastyworks?
Sure. Well, I mean, we are the same group that built Thinkorswim, and we'd have the same questions back then, and we obviously built it into a pretty wonderful platform because Schwab just paid about $26 billion for it from TD. And Tastyworks, all I can tell you is that there's 100 and something thousand accounts. There's a billion, over $1.5 billion in customer assets. There's 100,000 plus darts a day. I mean, we're probably the largest boutique firm in the world right now. I mean, and remember that Tastyworks does not hold your money either. So we use a clearing firm in Chicago called Apex, and Apex has a few million accounts. They're the largest independent clearing firm, and the accounts are, you have both the SIPC guarantees, which is the securities version of the account protection insurance, and then we also have an additional account protection insurance on top of that. So it depends on account size, but you're covered, I believe, up to 25 million and cash up to $1 million just with the insurance we have. And the other piece to it, you have to realize on the security side, I don't believe that there's ever been a securities firm that has actually lost customer money. There has been futures firms. I mean, the story of Revco, and the story of what was the other firm? Why can't I?
MF Global.
MF Global, right? I'm sorry, I was just on tip of my tongue. So MF Global and Revco, but those were futures firms under a different regulatory body. On the security side, I do not believe there's ever been a loss of any customer funds. So it's a pretty safe place. I mean, the industry is a pretty safe place as a whole. And actually, if you want to know the truth, in 2008, 2009, there were a lot of funds just as an example, at TD and a few other big firms where the funds went under $1 for their money funds. They actually lost money to par, and then they had to make it up or got sued for it. We didn't lose a penny. And so in the biggest meltdown in financial history, in history since the 87 crash, or really going back to the 29 crash, I mean, we were fine, no problems whatsoever. And the big firms had the most risk. They have the most capital, so they ladder out the most capital. We don't ladder out any capital. So our funds are all held in overnight repos. So we don't have a lot of risk unless it's, a specific incident type of thing. I kind of like our risk better than their risk. Let's put it that way.
Well, there you go. There you have it. Tom, I just want to thank you so much again for taking the time out and showing us Tastyworks, showing us, how you trade, answering all your questions. Again, just thank you so much for taking the time out here this afternoon. It's been really an enjoyment for me to have you on and answer these questions for our customers. And I think a lot of these questions were great questions, and I see a lot of opportunity here in Tastyworks for our clients that trade, these Iron Condors, these spreads, which are predominantly what our clients are trading. And I hope that you guys are able to take advantage of everything that Tom showed you here today and sign up for either a Tastyworks account or, take the trading challenge. It's a free paper trading account that you can trade a couple of days on. And if you make some money. You get to keep it if you open an account.
Yeah, Tony,
So
I should mention too that, and thank you for all the kind words and thanks everybody for listening. But if you're doing a lot of like, vertical spreads or credit spreads or iron condors, remember that the most we charge on any leg is $10. So if you do like 100 iron condors, it's only $10 a leg or $40. If you do 50 vertical spreads, it's only $20. It's the most you can pay. So it's a really great platform for spreads. You can roll spreads, you can do any kind of spread. It's super simple. So I just think I just want to make sure everybody understands that it's completely different than the rest of the industry. So and again, thank you so much. I can't believe it took us this long to do something together, but hopefully there'll be many more.
I know I would love to have you back. In the future, this would be great for us to do
Anytime.
something on a regular basis for you to show more about Tastyworks. And I love just talking to you about trading as well. I'd love to continue our conversations about kind of what you're trading and maybe get into some actual trades next time.
Anytime, man. Anytime. Thanks, everybody.
Thanks so much, Tom. I hope you have a great afternoon. And everyone else, thank you so much for taking the time out here this afternoon. The webinar of recording and the slides will get sent out to everyone with the links on how to sign up. So thank you so much, and I'll see you guys next Thursday. Have a good evening.